Welcome to Building the Blueprint, a podcast from ConnectOne Bank, where we help business owners lay the foundation for success. I'm Frank Sorrentino, Chairman, Founder, and CEO of ConnectOne Bank. Before I was a banker, I was a builder, and I spent the first half of my career growing my business. When I couldn't find a bank that truly understood what business owners needed, I decided to build one. Now, after 2 decades of building ConnectOne Bank, I want to share some insights to help others in building their business. In each episode, my team and I will break down economic shifts, government policies, and financial trends, translating complex business topics into clear insights so you can build smarter, move faster, and stay ahead. This is your blueprint for building something better. So let's get to work. Hi, joining me today is ConnectOne's own treasurer, Steve Primiano, on the show to take a deep dive into 25 and the trends you can expect. Steve, this is just a continuation of our past conversations as we try to figure out what to do every day here at ConnectOne.
Yep, Frank, I'm looking forward to continuing that conversation, and I hope your chair is in the upright position for it.
Well, we got some great topics to cover today, from the Fed rates to the 3 T's, taxes, tariffs, trade. We'll discuss all the business news, some of which probably just came out this morning, and bring it all back to Main Street to ensure that everyone out there has the knowledge to be able to deal with things as they're occurring day by day.
Yep, and I'm excited to be here and break those down with you, Frank, and discussing building the blueprint with our businesses. So let's start with some context from your Forbes blog back in January of 2024, titled Economic Indicators Signal an Optimistic Yet Challenging Year. And then a quick quote I pulled from that: recent data signals not just the potential for recovery, but also for robust growth and a thriving business environment. Well, now sitting here in 2025, I got to say, with the benefit of hindsight, was a pretty good view on 2024, which I'm going to sum up real quickly as follows. Growth was resilient, inflation got tamed, the jobs market remained historically robust, and the Fed turned the corner on rates, cutting 100 basis points in total in 3 separate rate cuts. So now, Frank, as we sit here today, we're in 2025, and to me, it feels like the environment is yet again changing beneath my feet. And I don't know if it's every minute, every hour, every second. And you've always done a really good job, and I think, cutting through that noise. So let's start there. What do you think, Frank, 2025 has in store for us and our businesses?
Well, as you mentioned, Steve, 24 was really an interesting, challenging, but a quite successful year as we closed out the year. I think it set the foundation for what I believe is going to be a pretty robust 25. I know I used the word robust a lot in the beginning of 24, and I got criticized for it. But when you think about the things that really contributed to why 24 turned into what it was, we start off with employment. Employment was incredibly strong and remained so throughout the entire year. And interest rates, while everyone kept talking about how interest rates were so high, in fact, they were just getting normalized. And so that normalization of interest rates with inflation coming down, I think that plus employment set up the year in 24 to end in an incredibly strong place. We sit here today, let's not forget, we are the largest economy in the world. We're growing at 2 to 3% on a GDP basis. Everyone's feeling good. Everyone has a job. Their neighbors have a job. Everyone is thinking about the future. Everyone's thinking about how they can improve themselves. The housing market, as we've talked about so many times, because this is something we're very much involved in and we can get back to later, but we are underbuilt in houses. People are looking for homes. People are buying homes at a rapid pace. All of these things are contributing to the economy as we sort of move through into 25. I think the foundation has been set for an incredibly robust 25. And now with some of the changes that we're seeing around various policies and change in administration, I think that's just adding some jet fuel to all the things that I thought were going to be successful as we got to the end of 24.
And I would have to agree there, Frank. And when I always think about change, I think the side of the coin that brings opportunity, right? So when I think about 2024 from interest rate perspective, I think we entered the year with a general high level of uncertainty about the future of rates. And that conversation transitioned to not if the Fed would cut, but when. And now I think as we've entered 2025, that conversation has shifted. And I don't know about you, but whenever I get coffee or fill up my water every single morning, it's, hey, how are you? Where are rates going? So maybe we can dig a little bit deeper there. I think you mentioned it in some of those comments, and I appreciate it. Where do you think, Frank, rates are headed this year? And then ultimately, what does that tell you about the direction of the economy?
Well, before we talk about the rates themselves, let's just talk about something you mentioned before, which is this whole concept of, what's in the news, what are people's expectation, what are folks focusing on? And I think this is going to be a recurring theme as we talk today through a variety of different issues, right? We talked about the three T's. This concept of, let's not necessarily pay attention to every headline you read in the morning when you open up your, iPad or whatever, or pick up the newspaper. Headlines are there to sell the news. What's happening on the ground is what's more important. And so to your point, when people talk to me about, oh my God, interest rates went up by X and they were this and now they're that, I always boil it down to ask them, so what does that mean to your business? Like, what change happened in your business that's negatively impacting, or are you just reacting to the news that there's been a change in rates? And so when people come to me also and say, hey, are rates going to go down? What are they going to go down to? Again, I want to ask that question. What is going on in your own business? And what are the markers that you need to look at? I try to remind people that, be careful what you're wishing for. Moving from a higher rate environment to a lower rate environment means there's some weaknesses in the economy. The Fed isn't just lowering rates because you feel like you want lower rates. They're lowering rates because they sense the economy is slowing down. Is that what you really want in your business? I don't know about you, but for me, I'd rather be in a somewhat higher interest rate environment with a more robust economy, because the robust economy allows my business to do better, and so therefore I can offset those higher rates. Getting back to the actual rates themselves, as you said before, and what I keep reminding people, the Fed doesn't just, pick a number out. They don't have a jar with all the interest rates in it and pick numbers out of it. They say, hey, what is the data telling us? We just said, you can't build enough homes. Construction jobs are at an all-time high. There's more construction going on between home building, infrastructure, heavy and highway, green energy, just fossil fuel, you name it. There's construction going on across the entire country, if not the entire globe. And so that's a big impetus into the economy. When you look at consumer spending, when you look at lots of other things, the Fed is looking at this data at this point in time. And in my opinion, they're saying, hey, the economy's pretty strong. We don't really need to lower rates. And I think even one of the Fed governors commented that there may even be a case to raise rates going forward this year. I know that may be sacrilegious to some, but to me, that says we have an incredibly robust economy, and the Fed is going to wait it out and see where things go. Could we get one or two rate cuts as we get further out in this year? I think that's conceivable and possible. But for right now, from what all the things we see and all the things our clients are telling us that they're seeing, I don't see rates moving.
I would have to agree there, Frank. And I do want to unpack something there a little further, and that's essentially how you see the economy shaping up right now. When you think about rates over the past 2 to 3 years, I believe the yield curve was inverted for a historically long period, which up until this moment in history has been preceded by a recession. There was a long debate over the soft landing, hard landing, no landing. As a pilot, I think you have a unique insight into the ability to land a plane and what it takes to land it softly. Do you have a view on where you think the Fed is there? Because to me, I have to agree with you. This higher for longer to me sounds like stronger for longer when you think about the economic conditions in the macro sense.
Well, look, I think that what we saw happen, and we've talked, Steve, you and I talked about this a lot last year, and I've talked about this to other clients. The idea that we were going to go into a traditional recession in 2024 just made no sense to me whatsoever. Interest rates were coming down. The Fed was seeing things slow down a bit, but there was just so much liquidity in the system and so much, incentive and spending that was going on all across the country, both from government spending, business spending, technology spending. In my mind, that was all pre-filling sort of the bucket of that soft landing. And so there was just no chance that we were going to go negative on a GDP basis with all this stimulus that was still unwinding. And by the way, part of that is still true today. There is an enormous amount of stimulus still out there. There's an enormous amount of liquidity still out there in the Fed's balance sheet. For those who aren't aware, you should take a look at the amount of the Fed balance sheet, what it grew from pre-COVID, through COVID, and on to today. It's at record highs. And that is a stimulant to the economy. That money has to go somewhere. And so this idea that we were going to somehow go negative just seemed impossible to me. Okay, so now we created this soft landing. So we basically had the recession, but we fixed it before it actually happened, is what I would say is what really happened on the ground. And people who did have any struggle whatsoever had sort of a safety net under them. And now we're on the rebound. So yes, we could spend a lot of time thinking about what that safety net looked like and what industries got impacted or negatively impacted or positively impacted. But for the most part, for the entire economy, the economy remained fairly strong as we went through that cycle. We're now on the other side of that cycle. The Fed's balance sheet has now been shrinking and has been coming back into a more normal state. Interest rates have now risen to a more normal state. If somebody would have told me 30 years ago that I could have a 5.5% mortgage, I would have said, oh my God, where do I sign up? And that's where we are today, right? 5.5%, 6% mortgage is attainable today. That's a good place for us to be. And it's still, I believe, creates incentives for the economy to continue to move forward. So I see a fairly good slope out of where we are today. Now, add to that some of the other aspects of the economy, whether it's deregulation, whether it's a lot of other things. And then there are some negatives, that are offsetting what might be a positive direction of our economy that we could talk about, whether it's tariffs or taxes or other things.
Yes, I would definitely agree on the push and pull nature out there that's either real or perceived at the current moment. And I do think it's important to stress something you mentioned there, Frank, which is the Fed's not just cutting interest rates or maintaining interest rates, they're also shrinking the size of their balance sheet, which, as we know,
And Steve, I've told people all the time that may be more important than the actual rate of interest rates, right? We were talking about this for 2 years going, is that the economic impact of the Fed increasing its balance sheet way outweighs any change in interest rate in my mind. And right now, you talked about bank deposits, or you talk about how banks are being positively or negatively impacted with the inverted yield curve. What's more important is what's the Fed doing with their balance sheet? Because as they continue to contract that balance sheet, if we don't have strong growth, then the money supply would shrink. And I believe this is true, but the last few months, the money supply hasn't really been shrinking. And I think that's why you're seeing the growth that you're seeing. So even though the Fed is shrinking its balance sheet, and basically what does that mean? It means they're taking currency out of the economy. They're taking funds away. They're taking a punch bowl away, when things are rip roaring. At the exact same time, the economy is growing, adding more currency to the economy. And so that's what's providing now sort of the boost for the economy to keep going. At some point, the Fed will stop the reduction of its balance sheet and the economy will continue to grow. That's one of the things that I'm looking at to say, I believe 25 is going to be a fantastic year.
As a treasurer and a left-brained finance mind, I always come to the point where we have more certainty, right? And when you get certainty of the ability to strategically plan, forecast, project out cash flows, and really get some efficiency built into where you think the business model's heading. And then along with that, you're seeing that continued resilience, as you mentioned, both in business investment on a macro basis and surprisingly to some, but maybe not surprisingly to some, depending on what day of the week it is or what month of the year, the consumer, right? And I think the consumer has just been consistently resilient. And you've seen that spend or behavior evolve over time, prioritizing certain segments of the economy. So it's not just about what the Fed's doing with interest rates, it's managing the entire boat of the US economy. And just bringing it back to where we are today in the last Fed meeting, we know they, I'll say, installed a little bit more wait and see kind of mindset. You pointed out a little bit earlier, some Fed members recently could be even prompting some Fed rate increases. I don't foresee it. I'm with you. I think we get a cut or two, but it's gradual, which is okay. It's probably better. So you got gradual growth, gradual rates, good predictability. However, when we bring it back to the current administration and President Trump's view on rates, I think there might come a little instance of pushing and pulling, as you alluded to, on the independence itself of the Fed and the role for the U.S. economy. I'm wondering if you just have any views on that or insights as you think through it.
It's a great topic, Steve. There's been a lot written about the independence of the Fed and how far back that goes. And there are a couple of different schools of thought there, right? So one school of thought, obviously, is the Fed should be completely independent and not take any input from any political side. But you know what? The American people spoke, and the American people said, hey, we want to see a change in direction here. So while I absolutely respect the independence of the Fed, I do think that there are different administrations think about the economy in different ways. And I think the Fed has to include that in their calculus. So I don't think the president should be forcing the Fed, to do one thing or another or whatever. I do believe in this level of independence, but independence doesn't mean just block everything else out that's going on. There's a clear sense of direction here as to where we want how we want our economy to function, where we want it to go, and what we believe success is and how we're going to get there. And I think the Fed has to think about how to manage that going forward so we don't do anything that destroys our money supply. So yes, independent Fed, but I think they need to think a little bit about what's on the horizon, because all of the policies that the administration puts into place impact the Fed. So it's a very symbiotic relationship. So that would be my view. I do think that the president gets to appoint members of the Fed, and so obviously that has an impact. He appointed the current Fed chair, and so I do think that we will see a Fed that thinks about the directional focus of this administration in how they set their policy.
And I would have to agree there, Frank, especially as you listen to the comments from the chair from the last meeting. You definitely saw a Fed that we know is data dependent, but they're also, to some extent, looking through what the data is telling them. And just to transition to the tariff topic, because that was, to some instance, either voiced by the chair or some members post the meeting. I'm just wondering, there's a lot of news out there and it's changing, I think, again, by the day. But as you think about tariffs and what it might mean for the U.S. economy and our clients, what do you think that all means? How do we unpack that going forward?
I'm going to go back to my news headline story. I think, when we talk about tariffs, it's a very complicated scenario. I think we can go back 100 years and we still don't really know exactly what tariffs will or won't do in particular parts of the economy. And certainly today, our economy is very different than it was in the 1920s, right? We have some experience. So there are some who say high tariffs actually created the Great Depression. And there's some evidence that that was a part of, what happened there. But by the same token, we're sitting in a position today where we believe that our country, the United States, is not being treated fairly across many of our trading partners around the world. And so that's one aspect of the conversation. The other aspect, which I think has become quite clear, certainly in the last few days, is that tariffs are being used as a bludgeon. And we want to get certain things from certain countries, certain policies enacted. We want fair play across the globe for Americans and for the United States. And so a lot of it is coming down to negotiating tactics. And as recently as today, I think you have seen that has become a successful negotiating tactic. So I say, don't worry so much about the headlines. Let's worry about what actually gets enacted. Let's see it through. If all the tariffs that are being talked about were enacted today, I think it impacts something like 6% of the entire GDP. So I don't know. I think we can manage that. We'll figure it out no matter what happens. The one industry that, certainly I keep a very close eye on and have been trying to better understand how tariffs may negatively impact would be the building and construction industry, because we do a lot of trade with Canada, but it appears that that's probably off the table, so less of a concern. So to me, that's where it all sort of lays out. I would say let's wait till we see the whites of the eyes of the actual tariffs themselves and how they're going to play out, because I'm not so sure we're going to get there.
Yeah, I believe it was the Wall Street Journal this morning that had a headline, The Art of the Temporary Deal, which very much feels like what's going on. And I do believe, to your point, tariffs are a one-time adjustment in nature. So if they do stay on, they're small, the impacts realized up front, realized over time, and then there's a healthy debate whether ultimately they're inflationary or disinflationary. But when you think about, I guess, a lot of the perceived changes in this new administration, from a banking or overall business landscape, to me, it feels very pro-business minded. I wonder if you can just share your views, what you think there, how you see this playing out over the very near term and what's still to come.
Just circling back to tariffs for one last bite. Again, just like interest rates and what I said before, that potentially higher interest rates don't necessarily mean bad things, and there are some who benefit from higher interest rates. Right? Certainly, anybody who's a saver benefits from a higher interest rate because they get more money on their deposit account. So a whole class of seniors do better in higher interest rate environments. So there are winners and losers in all of these policy changes, and the same thing with tariffs. So there are, everyone's complaining about the cost side of tariffs. So, oh, wait a minute, something I buy is going to be more expensive because we're going to only be able to source it here in the United States, or there's a tax applied for buying something from a foreign country. There's also those who benefit in our country from that, right? Which is somewhat of an offset. There are those who will now have pricing power where they didn't have it before because they had to compete unfairly, with a lower priced product coming from overseas. So, when we talk about business, there will be businesses who lose if there are tariffs placed, but there will be businesses that win as well. And the real trick for the Fed and for policymakers and whatever is to figure out, where does that balance, sort of find? Are we better off or worse off depending on what we do? And there's no one to say that we don't try something, and if it doesn't work, we'll go back and try something else. So this winner-loser concept has to be taken into consideration in all of these various policy decisions, whether it's tariffs, taxes, interest rates, or whatever. As far as the business orientation of this administration, one of the things that's a very stark difference between this administration and the previous one had a lot of academics, politicians, and whatnot in various cabinet positions. This one is very, very much focused around business owners. People with a lot of business experience are getting cabinet positions, or getting put in charge of various departments in the government, and that's going to have an impact. Now, some will say that's a negative impact. Others will say it's a positive impact from our perspective and what we do. We're in the financial business. We're here to support businesses, small, medium, large, across the country. To me, that sounds like a better policy. And I think we're seeing optimism in other business owners today, right? There's been this sense of, hey, we're back to thinking about business, and there are business owners making decisions about the proper amount of regulation, where interest rates should be, taxation policies, tariff policies. And so it's not an academic approach. It's a real life, real experience type of way of thinking. And I think people in the business community are becoming very enthused about that way of thinking.
Yeah, Frank, I don't know if you would agree, but I almost feel like where we're sitting today from a business perspective, I got to think we're at the most resilient point. When you think about tariffs, supply chains are more resilient than they were, liquidity is better than it's ever been, balance sheets are positioned more than ever been. Thinking about interest rates have more or less been at this steady level for, I believe, 24 to 36 months. So when you combine that with a pro-business administration and the opportunities to come through change, would you agree, to your opening comments, 2025 is set up fairly well to see continued success from a macro standpoint?
But one thing I can tell you is that when we looked at 24, the one thing that we certainly here at ConnectOne Bank, right, we talked about the Fed balance sheet and the amount of liquidity and constraints around finance. And if you would extend that conversation to the regulatory environment and sort of it certainly wasn't a pro-banking environment. I wouldn't say it was an anti-banking environment, but it was a very restrictive banking environment that we just came out of. I always wondered how people, factored their thinking in here. Banking is the oil and the grease for the U.S. economy. It is what keeps the engine running. And so if you throttle that, if you put your, hands around the neck of that, of the financial space, and you provide for less lending going on in the marketplaces, which is what we saw as we moved through 24, it's going to hold the economy back. And if you start to, enact and think about policies and regulation in a way that allows financial companies to excel and do more and be better at what they do, it's only natural that businesses follow. And there'll be more lending and there'll be more capital creation and more capital investment because the lending will be there to follow. And so to me, that by itself is such an important aspect of why I believe the economy is going to do incredibly well in 2025.
I would agree. And then on the heels of that, we still haven't really begun the tax discussion for the year. As we know, the Trump 2017 tax cuts expire at the end of this year. And that process, I believe, is going to start playing out in the near term through the budgetary, I'll say, evolution. In your view, where do you think tax rates are ultimately going to go? And do you think that just continues the acceleration of the economy?
Yeah, so that's a tough one. Certainly, I would believe that the 2017 tax cuts would probably remain in force. There may be some tweaking there, here or there. And I think that all by itself really doesn't do a whole lot or change a whole lot of direction. We've had them since then, since 17. So we know what to expect. We know how that interacts with the economy today. What's more interesting to start to conceive is some of the other changes that they're contemplating, this administration is contemplating. And whether that's, changes to the business tax, as we saw in 2017, that had a big impact on business investment and valuations in the marketplace. And so that could be a big positive driver. This conversation about eliminating income taxes or lowering income taxes or whatever, I think those are going to be very, very difficult conversations to have with the level of the deficit we have and just the political will on both sides of the aisle to get something like that done. Yes to extending the 17 cuts. Yes, I think there'll be some things going on around the edges that'll be pretty easy to get done. But I think the more difficult conversations about revamping the entire income tax system is going to be I think it's just going to be a harder play.
I would agree. And then we'll definitely continue to keep an eye on it as the year unfolds. You mentioned the deficit, so I got to bring up Doge. And not just because my 7-year-old's favorite car is a Cybertruck, but just when I come in every day, I just think about efficiency, right? So when you think about Doge and what it's set out to do is really to bring efficiency into the government. When you started ConnectOne, efficiency and the client experience were top of mind. So when you think about efficiency, how do you think our clients ultimately should be thinking about how to incorporate that into their businesses?
I talk about it a lot, Steve, as you know. We've run our institution at one of the best efficiency ratios in the nation for most of our 20 years. And to me, that's really important. I think it's important for business owners to think about efficient means of everything they do, right? Whether it's, the utilization of capital, how they use lending, how they use human resources, that you're not wasteful in the things that you do. Get the most out of what you have. I got a lot of my lessons from, my grandfather who lived through the Great Depression. And, he would be mortified today if he saw this throwaway economy. They used and reused. He would straighten nails out, after they were used, pull them out of an old 2x4. It was that type of a mindset, of a way of thinking, because materials were scarce and things were expensive and you just couldn't afford to throw things away. And yet here we are in this economy we have today, where I think we create more waste, than probably anybody else on the planet. And so for me, I always felt there was an economic advantage for any company that could get more efficient than their competitors. And yes, it's always great to watch the revenue coming in and know you can't cut your way to great profitability. But you also can't have companies that are doing really well on the top line and just letting it all go out on the bottom. Generally, you see the best run companies are pretty efficient, and they care about their clients, but they also think about that efficiency of resources and the utilization of those resources. By the way, that also sends a cultural message throughout your company about what you value and that you're not wasteful. And I think that's an important message. I don't think there's too many people that would disagree, or I think there are a lot of people who would agree with the statement that our government is probably pretty wasteful. And there are a lot of things that we do that we really don't get any benefit for. And so this whole idea of, hey, let's take a break here and let's take a look at everything we do. It's sort of like that Saturday morning when it's like, okay, you know what? We're going to open up the garage door today and let's take a look in there. We're going to take everything out of the garage. We're going to pile it on the driveway, and then we're only going to put back the stuff that we've used in the last year, and everything else we're going to throw in a dumpster. Every once in a while, you got to do that, and I think we're at that point.
That's my favorite weekend of the month because I do it at least probably monthly. And I can tell you, growing up, if I didn't finish my breakfast, I could have it for dinner. It'd still be on the table. So I totally agree with those thoughts there, Frank. Now, when we bring that all back to 2025 and thinking about small businesses out there listening to this, and I'll call that the book smarts of it, what do we think about the street smarts perspective? So given the outlook on the economy, given the more certainty of rates, given the more pro-business environment, what do you think is important for businesses to keep in mind to continue to succeed in 2020 and 2025 and beyond?
Steve, I always bring it back to, the same conversation about, should I be watching interest rates? Should I be making a decision based on what the Fed does? Should I, be worried about tariffs? Should I be worried about all these other things when I'm asked this in clients? And my answer is always, you know what? Talk to your clients, right? I spend a lot of time speaking to our clients about what they are experiencing on the ground, and we make decisions based on what they tell us. I don't read the Wall Street Journal, The Economist, or any of the other economic newspapers to decide what we're going to do or not do. I take that feedback directly from our clients. What are they doing? What are they thinking? Where are they seeing the opportunities? And probably more importantly, where are they seeing those challenges? And so this idea of getting close to your clients, we talk about 50 cups of coffee at ConnectOne Bank all the time, right? Get out there, go talk to people, try to understand what's really happening on the ground. Forget about the noise, forget about the hysteria. Find out what's really happening. You're probably going to see a somewhat different picture than what you read in the newspaper. That's what you should act on, and that's what you should react to. People ask me all the time, how did you know to do, to move to the left instead of the right? Or how did you know that, going into construction lending in 2009 was a smart move? Why? Because I talked to our clients. They were telling us what was happening on the ground. And that was so my reaction to that and how we've brought that to the company, right? Our reaction to what our clients need and want at a particular time is what set us up for our success.
I don't think of any better way to wrap up this podcast. Well said, Frank. Thank you for your insights. I appreciate you having me. Thank you, everybody, for listening. And Frank, I'll turn it back over to you.
Steve, always great to be with you, and I always enjoy sparring with you on all of these topics as we go along through the year. We generally agree, but sometimes I'm not so sure.
I was going to say my devil's advocate nature might push and pull on you a little bit at sometimes too.
But we've always had some great dialogue about all these topics, and hope they will continue in the future. I want to thank everyone for listening here today, and hope you enjoyed listening to this podcast, and you'll join us again.
ConnectOne Bank, member FDIC, equal housing lender. Additional disclosures can be found at www.connectonebank.com.